South Africa is showing sustained signs of a slow but steady economic recovery. The economy grew by 0.5% in the third quarter, following a revised 0.9% growth between April and June, marking 4 straight quarters of expansion. Agriculture playing a major role in lifting growth is something agricultural economist Wandile Sihlobo expected, as the sector continues to bounce back from earlier disruptions.
We've had one of the excellent seasons. I mean, you think about soybean, record crop this year. In maize, second largest crop on record, and all of the other field crops. But most importantly, also in the horticulture, fruits and vegetables, we've seen that the production levels have been exceptional, which has boosted both exports also and just the general activity domestically. And I think those two subsectors alone will be sufficient to deliver solid growth to agriculture.
Sihlobo says there is still room for stronger, more inclusive growth, especially as government rolls out a national vaccination program to tackle foot and mouth disease and other pressures holding the sector back.
South Africa's agriculture has the potential to see its gross value expanding by plus 30%. That, of course, is dependent on us releasing some of the land that is owned by the state to Black South Africans with title deeds, and then they can farm that. That's a sizable amount of land, Ntokozo, just over 2.5 million hectares of land. It's not the land that the government has to go and buy from white farmers. It's the land that it has already bought in the open market and paid a fair value for it. So it's really about distributing it at this time around. But you and I know that the core problems of South Africa is poverty, it's unemployment, and it's slow growth. And if we succeed in bringing that land into full production, we estimate that there could be close to 1 million jobs that could be created in agriculture and its value chain.
And investment, after months of decline, is finally creeping back up. Stats says agriculture is likely to be one of the winners as overall capital formation improves.
We see investment picking up to 1.6%, and over time, this is one of the expenditure metrics that have lagged quite a bit. We saw a lot of contraction from Q3 2023. We only had that slight positive in Q3 of 24. Now we have a bit of a more significant growth of 1.6%. So it'll be interesting to know where that growth comes from. Again, we can compare the 2 quarters with each other. This time around, we can see that a lot of this growth comes from the middle of the graph, the transport equipment, which ties up nicely with households also purchasing transport equipment. We saw manufacturing doing well for motor vehicles. Expenditure on transport equipment for CapEx gave us 0.7. We also had capital formation in the areas of airlines as well as the shipping industry.
The only sector that shrunk in the third quarter was the electricity, gas and water industry, which fell by 2.5%, pulling GDP down by 0.1 percentage points. Stats says this may have been driven by lower electricity production and consumption, as well as improved efficiency, partly because industries like agriculture, mining and manufacturing are increasingly generating their own power. De Beer says all 5 expenditure components expanded in the quarter, with the biggest push coming from household spending and capital investments. Household consumption has now grown for nearly 2 years, supported by the 2-part retirement withdrawals and lower interest rates, which have put money in people's pockets. Government spending also grew for a second consecutive quarter, mainly due to higher employment. For Newzroom Afrika on Channel 405, I'm Ntokozo Khumalo in Pretoria.